In today's episode, we will debunk a very popular theory. It's called the zone recovery trading system. We will go deeper to this technique and we will analyze all the aspects and why this technique doesn't work. I mean, it can guarantee a 100% success ratio, and this is true. But let's go deeper into the theory. Every time I like to trade in real accounts, in real situations, and in real markets, because in theory we could say a lot of things about how the market moves and put a diagram on something that already happened in the past and something that already being so let's see in a live market. Of course, we are on the weekends. Unfortunately, I don't have time to upload so many videos. The market is closed. I will use the euro yen. I choose it randomly. I have also opened the daily chart. Now our fellow trader will use a 1 to 3 risk reward ratio. Of course, you can change that. You can test that if you do it bigger, if you do it smaller. The whole idea of this series and these episodes is to debunk and understand in depth how a theory that seems that it's working eventually it's not. So our fellow trader had a dream about a very successful technique. So he thinks, why to lose a trade and not open an opposite trade instead? He wakes up, he's very excited, or she, I don't know, and she start thinking that he can beat the market. He thinks that he reinvented the wheel and he's ready to go against everyone out there. So in this example, I have used the boxes. The size of the box represent the size of the lot, the size of the opening side of the trade. So our fellow trader at this point, at this time, he doesn't care about any technique, any strategies, any previous support, any previous resistances, any waves. He doesn't care about anything. He's got his technique ready to work. So he does a buy order, let's say. He risks 1 to 3. So his expectations is to go 3 times higher and then he will be profitable. And if the price is hit this price, the stop loss will be triggered. He will lose the trade, but not this time. This time he came with a new weapon technique. He will use the zone recovery. Now the prices indeed goes lower and he's opening an opposite order. Now he's got the buy order and a sell order, but in order for this to work, the sell order must be bigger than his previous order. Now what's the plan here? He also risks a 1 to 3. If the prices moves at this point, he will get his profit because this side will cover all the losses from his buy order. The prices doesn't move in his favor. They are keep shooting up. Remember, now he's got 2 orders open. At this point, his initial trade, he's very lucky again because he won't lose any of these trades. He will open an opposite buy order on 1 to 3 risk reward ratio. Again, this is constant, it doesn't change. You can change it if you want, but for this experiment we will just use these constant numbers to understand the technique. So at this point he triggers another buy order much bigger than the previous ones. Now he says that if the market goes 3 times higher, he will be again profitable because now he's got much bigger order to cover losses from the previous orders. The market momentarily at this point penetrates his initial price, so another opposite sell order is triggered. Now he doesn't care again. He says that if the prices goes lower, 3 times lower, then I will have a profit because now I have a much bigger size to cover all the losses from my previous ones. But the market shoots momentarily at this point. So what it does, it triggers another buy order. I gave just a random example here to understand. Now he's got 5 orders open, but he's very lucky. He does. The price is moved 3 times higher at this point. And eventually our trader is a winner trader. He found the technique. He can beat the market. He knows how to do it. Unfortunately, there is a nightmare behind this dream, and this nightmare, it's called the martingale technique. But let's go further and see what is a martingale technique. Martingale started from a group of betting strategies in France in the 18th century. The player wins if he can guess correctly in a flip coin game the outcome. The outcome, of course, has a 50% chance of winning probability, let's say. I have also made another video on the flip coin if you want to check in one of my videos. It will be much easier. I have explained some maths behind this statistical probability of 1 to 2. Now, how this martingale strategy works. Let's say that our player is willing to bet 1 to take 2. For every 1 that he's betting, he's getting back 2. At his first bet, he will just bet 1, and his expectations would be to get back 2. If he wins the bet, then he's a winner. But let's say that he's losing the bet. Now he's going to the second stage. In order to recover from his previous losses, now he will have to bet twice the amount. And if he wins, he will take 4. Remember that he already lost 3. So the only profit for him will be his initial bet. And this goes on and on. Actually, you are trying to recover just to get a very small amount in return. This goes exponentially higher and higher and higher. So imagine that you have to have infinite money just to keep doubling your size, betting again and again. There are maths behind it to the other side that you will say that you are not correct. And what I mean by that, in a flip coin game, you have a 50% chance of winning. Now let's go to consecutive wins or consecutive loss. The chances of having 5 consecutive losses in a row, it's it's 3.125%. You can check my flip coin video that I have given a table with the chances. So actually you have a 96% chance. Actually no, let's go to the opposite way. You have just 3% losing at the 5th, losing 5 consecutive bets. So at the number 6 or 7, the maths goes smaller and smaller. They will never become 0. So what is the problem when we are transfer our example in our trading technique? Remember, our trader, he doesn't want to lose any trades, so every time he increases his size. In the profit risk reward that I use is 1 to 3. You can use 1 to 2, 1 to 4, 1 to 5. The bigger the risk reward ratio, the more pips you will expect your trade to travel, let's say, to pass. So the more trades you probably need to open in the meantime. So in the first trade, the lot size was 1, the risk was 1, and check now the account size, how it will exponentially sky high as we keep increasing our trades. We are increasing our trades, the market goes up and down, and always putting us at a trade. Now remember that it's not only the 32%, you have also opened the previous trades. So imagine how big account size you need to have in order to win. Of course, someone can claim that why not to risk the 1% and not risk 0.5% or 0.0005% and so on. you understand there are limitations in trading. In trading, you are not trading just to trade. You need to be profitable. You need to make money at your trades. So imagine how much money, how much huge account size you need to make this kind of tests, and how catastrophically can go against you if you are using this technique. Of course, there are maths behind it that will say, okay, you won't be so unlucky. I mean, what is the chance of having consecutive wins at a row or consecutive losses? Because this is the problem. Actually, you won't have losses, but the prices won't move at your favor. So you will keep opening account size lots and risking more and more. And this is the problem with this technique, that eventually you need infinite amount of money to be successful. So it can guarantee 100% success if you are having infinite money to bet. I will try to upload a video at least once per week. I do not have so much time. This is the first episode of the series on Forex Debunked. We will take popular strategies and technique and we will test them. We will say what are the pros, what are the cons. If you want to leave a comment, please make sure that you have some kind of trading experience. Again, if you're not, you are feel free to do so. Thank you for watching. Thank you for your support, and I hope I'll see you in the future. Trade safe.